Hello, welcome to Cherry Bekaert's GovCon podcast, where we discuss current government contracting trends, compliance matters, and best practices to guide federal contractors forward. My name is Eric Poppe. I'm a senior manager with Cherry Bekaert's Government Contract Services Group. And today with me is Rich Wilkinson, Director of Product Marketing from Unanet. So today we're going to be talking, this is actually our second podcast in a series on indirect rates, how they affect GovCons and why it's more than just a math exercise. Rich, thanks for joining me.
My pleasure, Eric.
Before we really jump into rates again, I know last episode we talked about just rates at a high level and why they matter for government contractors. And today we're going to jump into monitoring and why it's a great tool and why it's fantastic for project management. Before we jump in, can you just give a little bit of background about yourself and your role at Unanet?
Sure. I've been all the way around the GovCon table, Eric. I was a contracting officer for 8 years, and then I spent 10 years on the other side of the fence as a working controller. And then I've been in the software industry now for more than 25 years, again, supporting government contractors, this time with accounting systems and software of that type. So I've developed rates, I've used rates, I've been on the buying side of rates and tried to negotiate them down. It's always a thorny issue, and it's one we all struggle with.
Definitely true. And calculating your rates through that rate cycle, from using budgets for your provisionals, monitoring then the actuals through the year based off and comparing that to your build, your provisional rates, the actuals to close out or incur cost mission, then close out. There's a lot of different checkpoints through the year. And you kind of have to get into a cadence. And with that monitoring exercise, do you just want to talk a little bit about how important that is and what are some best practices when it comes to calculating our rates?
Sure. If you go through the standard form, what is it? The pre-award survey.
SF 1408.
The 1408, right. If you go through that 1408 process, one of DCA's questions is, are you able to calculate your rates and how often do you do it? They want you to say, we do it every month. And when I was a working controller, that's exactly what I did. That's how I monitored my rates. I calculated them every month, but I'm going to make a little confession here. I didn't look at them for the first 3 months of the year, because everything fluctuates for the first month or two, and fringe is wildly out of control the first month or two because of the way payroll taxes are done in this country. So about March, I'd start paying attention to them. And that's where you start asking yourself, am I on track? Like we said in the last episode, the major question, whether you're a project manager or a controller, is always, where am I? And I'd look at my rates and say, where am I? And if I was off course, too high or too low, though that was never the problem, too high was usually the problem, what do I do about it? Do I go cut some spending somewhere to get the rates back where they need to be, or do I change my budget? And that's always the question. It might not happen in March, it might be June or July, but some point in the year, you're going to look at your rates and go, wait a minute, that particular indirect rate's not where I want it to be. Then what?
So from that tracking standpoint, you shouldn't be alarmed with those fluctuations in the beginning of the year, but as you're tracking throughout the year, you really should be trying to pay attention to what's happening in those pools and bases. And does it, one, make sense just from a sanity perspective? Now, two, you would want to make then a course correction or maybe make an adjustment if there is a change in your business of some sort, or mid-year you do win a large award. So, how does one go about or a company go about tracking the budgets and tracking to then actual events that occur through the year? How does that impact the rates?
Well, hopefully your ERP is giving you tools to do that, a place to put the budget into the system, to track it, to show budget versus actuals when you calculate your rates. Because when you see a rate that's not where you think it ought to be, the first question you have to ask is this a one-time aberration? Is it going to smooth out by year end? Or is this a trend I'm looking at? If March was a little bit high and April was a little higher and May was a little higher than that and June is higher still, now I got a trend on my hands. I want to know what cost element's driving at. Is it rent? Is it equipment? Is it people? Is it what did I misestimate my leave accrual? What exactly is driving this trend? And if it's not something you can fix, then you need to ask yourself, well, should I revise my indirect rates? And by the way, if there's any money at all at risk, the answer is always yes.
Yeah.
You can revise your indirect rates as often as you need to. Now, if you did it every month, you'd irritate DCAA pretty good by year end. But I've worked for companies where we did it every quarter. We looked at the rates, and if they were even a little bit out, we revised our provisional rates.
Well, and you know, that's a good point, because I feel like a lot of, especially if you're smaller and you're new to government contracting, or you're mostly commercial and you just won your first cost plus contract, that process of submitting your provisional rates and then asking to resubmit, or just resubmitting, sometimes it's kind of like the boogeyman, like, oh, I don't want to upset the government because I want to, but you could be leaving money on the table. And to your point, and then also from an audit standpoint, a financial risk, if there's too much of that variance, you could actually have impacts on your financial statements, and there could be adjustments that have to be made from that standpoint if you don't adjust your rates and you run too high or low.
Absolutely. And realistically, you know, there are people in the government I really don't want irritated with me, but they're in the program office or the contracting office. They're not at DCAA. I mean, I have a healthy respect for DCAA and a good bit of admiration for the work they do. But having an auditor irritated with me doesn't disturb my sleep one bit. So if I need to revise my provisional rates, I'm going to do it, because there's cash at risk here.
Yep.
And I can use that cash in the bank a lot better than I can having it sit on my balance sheet as a rate variance.
So that's a great, just my next question for you, actually. If you find that there's a variance and you submit for new provisional rates, what should you do with that variance, and when should you potentially bill that?
Instantly. If DCAA told me this afternoon that my revised provisional rates were approved, I would get it into my June billings, because they're not out the door yet. And if they were out the door, I'd get it into my July billings and bill that differential. A good ERP system is going to do that for you. You just change your rates and tell it to produce a rate differential billing, and it's going to do it. Our system does it. There are other systems that do it as well. Most good GovCon ERP systems will do that, and it would be foolish not to. Again, that money doesn't do me any good sitting on the balance sheet as uncollected or unbilled. I'd rather have it in the bank or pay down my line of credit with it. So I'm going to bill it just as soon as I can. And if my rates need revising again in September or October, I'm going to do it again and do another differential billing. Because, you know, a lot of your contracts, especially delivery orders, are going to run through 30 September.
Yep.
And if you've got a rate variance staring you in the face in August and you don't revise your rates and bill it, your program manager is going to spend that money by 30 September. And when you do revise your rates, there's not going to be anything there to bill against.
You know, that brought up an interesting point that we get questions about a decent amount at Cherry Becker with our clients. In that, and you know, you have rate variances and people are like, well, what happens if I win a new contract and I have to bring on 50 new or 100 new FTEs? And, you know, because of that, I'm going to have to open up a new, have new overhead expenses and have IT costs and new, you know, everything. Should I price this proposal for this potential new work? Should I change my rates, or should I use my current provisional? And we see it all the time that you should take into account potential new awards into pricing and using your rates for estimating purposes. But you know, you just can't affect that base, that denominator, that you need to affect
Right.
itself too. You know, what are those increasing costs and how does that impact my rates?
Well, there's one thing you definitely should do and one thing you definitely shouldn't do. The thing you should do is calculate what I call an impacted rate statement. You have your actuals where they're actually running.
Yep.
And then you have another column for what the new contract is going to do, increases in the pool and increases in the base. And then you calculate again, here's what my rates will look like after I win this new job. Definitely should do that. And if you want to win, and I think everybody does, you're going to price based on that impacted rate. Because if it drops your overhead 4, 5, 6 points, you definitely want to use that lower overhead in your proposal to do your pricing.
Yep.
What you should not do is submit a revised provisional rate statement because you haven't won yet.
Correct.
Hold that until you actually win, because you don't want to be billing lower than actual rates on the hope of winning something. And then if you don't win, and not everybody does, if there are 20 people bidding on that job, only one of you is going to win. Don't revise those provisional rates. Hold that until you do win. And those people actually start coming on board and you see the rates start to fall, then revise that provisional rate.
And that's when you start that cycle all over again of monitoring.
Absolutely.
And, I think we're going to end so that's a perfect, again, segue to our next episode. We're going to be talking about closing out the year and monitoring and looking at the variances again as you close out the year and that impact. So, Rich, I wanted to thank you again for joining me on this second episode on indirect rates.
My pleasure. I'll see you on the other side.
Thank you. Have a great day.